We've spent hours crunching numbers and playing with this, and we thoroughly enjoyed it. You might not enjoy some of the numbers in the next 2 sections. We'll have a question session after these. But I thought about the things that appear on a form P11D, a benefits in kind form. And I thought, actually, should my company now be paying my gym membership? Should my company now be paying my private medical insurance? So we've been doing some playing with some numbers to establish the answers to those questions for you. So this is going to get a little bit detailed for a couple of slides. So if my company pays my £600 gym membership per annum, it has an additional national insurance charge, a Class 1A national insurance charge, and that's charged at 13.8% of my gym membership. So the total cost to the company of paying my gym membership isn't actually the £600, it's £682.80. This is in your pack for you to follow if you're not on the right page. However, there is a corporation tax saving of 20% to be made. And as such, the cost to the company of paying my £600 gym membership post-tax is £546.24. So you're all going, well, why haven't I been doing this for years? Well, you haven't been doing this for years because from a personal tax point of view, if I swap hats, then as a basic rate taxpayer, I'm going to pay £120 in personal tax for the privilege of the company paying my gym membership, 20%. As a higher rate taxpayer, going forward, so the 5th of April 2017 year, I'm going to pay £270 for the privilege of the company paying my £600 gym membership. So the net cost as a basic rate taxpayer to the company and to me in that additional tax is 666, no idea why we use this number, 0.24. The net cost to the higher rate taxpayer looks like a whopping £816.24. But what becomes really interesting is when I'm paying dividend tax on the monies I'm extracting from the company to pay my gym membership. So as a basic rate taxpayer, to get that £600 in my pocket to go along to the gym and pay it, I have to take £648.65 from the company. As a higher rate taxpayer, I pay a whopping £888.89 to get my 600 quid to go to the gym. So actually, my conclusion is, if I'm a basic rate taxpayer, so I'm not going to cross that £32,000 worth of dividends level, I'd actually be worse off, but only marginally, £17.59 in this case. I'd be marginally worse off with the company paying my gym membership. As a higher rate taxpayer, I'm actually better off with the company paying my gym membership, and I'm better off by £72.65. This is pretty revolutionary stuff. Nobody's talking about this. I dare any of you to find an accountant's website that's making that recommendation to you. What do we have to do to be able to do this? Well, we need a receipt, we have to put it through the company books. We understand all of that. This word benefit in kind, however, means that once a year we have to administer an additional form. It's called a form P11D. And on that form, we capture benefits, payments that the company has made on our behalf that we need the company to pay its Class 1A national insurance liability on. So once a year, we pay Class 1A national insurance. Once a year, we fill in a new form. If you start doing this and we do your payroll administration for you, can you let me know so we know to put you on our control sheet and to chase you to do your P11D each year? That personal tax that I talked about, well, the personal tax we can do one of two ways. We can just pay it once a year on our self-assessment tax return through our payments on account, as we described earlier, or that value of that benefit in kind, we can have our tax code changed. So actually, we pay that tax as we go. So we're not even going to notice it's gone when we're earning 11 grand a year, are we? So I think that works really well for gym membership and for private medical insurance. So the other benefit in kind that we all talk about quite frequently is, should I have a company car? And the stock phrase and the line that you hear from me time and time again is, I roll my eyes and say, please don't have a company car, it's only going to cost you more money. Now, company cars is a really complex area, and it drives me potty when people say, can you just do the calculations on this 18 cars later? So please don't start doing that to me. But there is an opportunity here, potentially, depending on how you finance your car or how you want to finance your car in the future, that for some people with some cars, financed in some ways, company cars are actually now a good thing to be doing to save tax. Okay, I apologise for all the numbers on the following pages, but what I wanted to do was give you a cross-section of examples for you to be able to make an application to your personal situation or to your company situation. None of these are going to be relevant to anybody because nobody's going to go out and buy a Mitsubishi Outlander at exactly the list price that I've used in my thanks, Ryan, example that I've used. So we have to work the numbers specific to your case, but there is opportunity here. So the first section says, I actually want to lease a car. Okay, so when we're talking about financing, I want to lease a car, basically rent one. These calculations are on the basis of the 2016-17 year, and this works on the basis that I only have the car fully expensed from the company. I still pay for my private fuel. That's really important. If we throw fuel in as well, it gets really scary. So if I went onto a website on Saturday and I wanted to lease the three cars that I mentioned, a BMW 3 Series I.S.E. something or other, the cost to me of that annual lease would be £3,240. Whenever I look at a company car, I need to understand its list price and its CO2 emissions. We always pay tax based on the list price of the car, not the price we pay for it, the list price of the car. The two can be different. I need to understand the CO2 emissions of that vehicle to calculate the benefit in kind. What value does HMRC says that that car has to me? And that gives me basically a P11D value. So if I take the CO2 emissions of my BMW, then the P11D value is £7,139. So what HMRC are saying is that every year I have that as a lease car, they deem that the value to me would be £7,139. The company then has to pay to run that car. No fuel, remember. So this is simply, I take it for a service, I buy it a tyre, and I insure it. Might have to put some road fund licence on it, depending on the type of lease. So working down the column of my BMW 3 Series, the total cost to the company, including that wretched 13.8% Class 1A national insurance that we all now know about, the cost to the company of providing me with this car is £5,525. It can save corporation tax of 20%, so actually the net cost to the company is £4,420. This is a benefit in kind, so as a basic rate taxpayer, I'd have a £1,428 tax bill from the provision of this car. And as a higher rate taxpayer, I'd have a £3,213 personal tax bill. What that's given me is either a net cost to the company and me as the taxpayer personally of either £5,848 or £7,633. They sound quite high numbers, but let's do the same calculation as we did when we were looking at that £600 on my gym membership. If I was to lease that car, I couldn't claim the VAT back. A company that's VAT registered, not under the flat rate scheme, traditional method, can claim some of the VAT back on that lease price. So actually, going out and having a business lease is going to be cheaper for the company in the right scenario, as used in my example, than me personally. So to actually get that BMW as a lease car, I need to have in my pocket, after I've paid my dividend tax, £5,188. Basic rate taxpayer, it's going to cost me £5,609 in a dividend declaration to achieve that. As a higher rate taxpayer, that number goes up to £7,686. So actually looking at the cost between the company and myself, on the basic rate taxpayer example, we're basically comparing £5,848 net cost to the company of having it as a company car, or £5,609 cost to me and the company of having that as a private car and taking the dividend out. So in this example, with this particular car, I'm £239 worse off having a company car. On the same car as a higher rate taxpayer, I'm 53 quid better off. Now, just taking that across the columns, what we can see with my Mitsubishi Outlander or my really jazzy Mercedes A-Class 2.2, those numbers are fluctuating all over the place, and where we've got negatives in one place, we've got positives in the other. But what I'm saying to you is none of those numbers are huge. Right now, if I did that calculation, those numbers in this tax year would be circa £2,000 worse off having a company car. So with the introduction of dividend tax, the marginal difference between having a company car and having a personal lease car, there's very little in it on most of these cars. What that's beginning to say to me is, well, actually, the company could be carrying the risk, couldn't it? I've got really low maintenance costs in here. If I have a car on lease and there's a problem and it's a non-maintenance lease, or I have my BMW that eats tyres every week, actually the maintenance costs are the responsibility of the company, and I will be better off having a company car. As I say, this is very, very, very specific to the car I choose, to my personal situation, and to the lease price in the example of the leases. If this is something of interest to you, we need to collate that information to maybe make this relevant to you. But for the first time ever, you're going to hear Linda say, company cars can be attractive. Leasing isn't for everybody though, is it? So what happens if I wanted a loan to buy a car? So I wanted to go and buy that BMW and I wanted to take a £25,000 loan out. I could take that £25,000 loan out as a commercial loan, or I can take it out as a personal loan. I can own the car personally, or the company can own the car. Well, we've both got to service the loan repayments on that vehicle, haven't we? So I've continued the story of the BMW in your pack. Loan interest is a deductible expense to the limited company. So all of a sudden, my corporation tax saving is quite significant. Of course, if I'm paying loan interest personally, that's not deductible to anybody, is it? But what we can see, if we work our way through the numbers that are calculated in exactly the same manner, so you can think about your own vehicles and what you would choose to do and what you would want to do, what we can see as a higher rate taxpayer, as an example, the net cost to the company would be £12,658. For me to be able to take out the dividend to run the car and service the loan, actually it would cost me £16,752. What we're seeing, if you want to own a car that you want or you need a loan on to buy it, actually having that as a company car is beneficial. Okay, so it's just the BMW example, but if I work the numbers with a few different options, we can see quite exciting things. So HP agreements or loans, whichever way we want to go. So what I'm now sitting here thinking as I'm writing these notes is I'm going to have 25 telephone calls tomorrow asking me for you all to have your cars transferred from your personal ownership to the company. Our phone's going to ring constantly. Please don't. Okay. What I've proved to you in your pack is that if you're running a second-hand car that's not on finance and you don't have a loan attached to it, what's happened traditionally over the last 5 years is CO2 emissions of cars have gone like that. So the P11D value of cars has gone like that. We have to transfer the car from you personally to the company at a fair arm's length market value. So what we have in your notes is we have a Mazda 5 on a 2007 plate with 48,000 miles on the clock, and apparently today, if you were lucky enough to own one of those, its market value is £8,000. That car has CO2 emissions of 159. Most BMWs are probably pumping out CO2 emissions of less than 130 CO2 at the moment. Look where the marketplace has gone from 2007 to today. What you can also see is I looked up the list price of that car, and the list price of that car was £17,952. And remember, I told you that the benefit in kind, the P11D value, is always calculated on the original list price, not what the company paid for it. So if I go out and buy a second-hand car, or I transfer in from myself personally into the company at market value a car, I still have to go back to that original list price. If I do the calculations, I own the car outright. I don't have a loan on it. I don't have anything to pay on it. What you can see is it's going to cost you a huge amount of money to have that car as a company car, instead of keeping it in your personal ownership and taking a dividend to cover the costs of running that car, or your 45 pence per mile, which I've left out of the calculations on purpose. So we have to think about what we own at the moment. So maybe this is something when we're planning our next steps of car ownership or car lease or whatever it happens to be. But it's making it relevant and making it aware and making sure that you know about it. Okay, tax planning part 1 complete. Do we have any questions before I move on what we've talked about so far?
So if you have a car on a personal lease agreement,
yeah,
can you then transfer that?
No. So we have 2 separate legal entities. For the company to own the car, the company has to be responsible for its own liabilities. So something that we lease personally at the moment, we'd have to wait for the closure of that lease or negotiate with the lease company to pay off that lease and take a car. The lease would need to be in the name of the company. Okay.
What about an old classic car which would have a very low list value, no CO2 emissions?
Okay. Cars registered prior to 1998 have different benefit in kind rules. Okay. So cars back then were based on the CC. So there was 3 different CC bands. Okay. So we would need to work the calculations on that basis. But HMRC appreciated that there are cars that just didn't have CO2 emissions agreed at the time of manufacture.
So you have a car, you pay your insurance for that car on business use. Will the revenue look at personal usage and only allow you a percentage of the split of the insurance costs?
So are we working on the basis that you own the car?
So it's a personal car.
Okay, so if it's a personal car, all we can do is claim mileage at 45 pence per mile. Any costs relating to running that car are not deductible from the limited company. Okay, so the 45 pence per mile for the first 10,000 miles, the 25 pence per mile thereafter are to cover all running costs of a car that we own privately.
If it went into the company,
Yes,
if I had a company car,
yes,
and I was charging the company the insurance element,
okay.
will the revenue then look at a percentage?
No. So the benefit in kind that we pay is to take into account the personal usage of the car. Whether we drive it 1 mile personally or 100,000 miles personally, the benefit in kind calculation is exactly the same. Okay?
Which allows you the offset of the costs.
So because the company would own the vehicle, the company is responsible for paying all the costs of running that vehicle. So that would be insurance, road fund licence, maintenance, etc.
Which is why you have to take the benefit in kind taxation.
Absolutely, because you have a car that you could literally drive from here to Edinburgh every day for personal pleasure. Okay?